Good afternoon, Stephen. Welcome to the Buy Side Brief. Welcome to the podcast. How are you?
I am okay. How are you?
Yeah, very well, thank you. Very well. And for those that don't know Stephen, as a brief introduction, you're a trained accountant, 20 years on the sell side, various leading banks, and then 8 years on the buy side, and now running behind the balance sheet and have been doing so for 12 plus years. So regarding today's conversation, it would be great to understand a bit about your journey on the sell side, the buy side, a bit about your philosophy on the buy side, and then what you've been up to for the last 13 or so years behind the balance sheet. So just kicking off, I understand a lot's changed on the sell side since you started out your career. A very direct question: if you were to start your career now, is it something that you would position yourself and go to the sell side? Would you start and try and get onto the buy side, or would you potentially look at a completely different industry?
I mean, if I decided I was looking for an investing career, then what I would do today would be to look at the opportunity set. You know, when I started, the sell side was the place where all the smart people were, and the buy side was you got paid less, and it wasn't as interesting a career. It was a backwater, and the sell side was where all the action was, and that's not exactly what I mean. I went in just by accident. If I was doing it today, it's actually very hard to get into the buy side today. So if you actually want to get into it, then you might be better off starting on the sell side. People don't agree with this philosophy, but I think that the sell side's a very good training ground. Obviously, it's called the sell side for a reason, and you need to be able to sell yourself and your ideas. But there's probably more opportunity on the sell side than there is in the buy side, simply because there's more rotation. And if you're interested in getting into the buy side, then if you go into the sell side, you get exposure to a lot of different firms, and if you're any good, one of them will take you on, and so it's a good training ground.
Makes sense. And given the fact that you're a trained accountant and you've done that almost at the beginning of your career, when you look at individuals that do training, in-person training on your courses now, when you've been on the buy side in investment teams, can you tell an individual that's got an accountancy background and one that hasn't? Is there a material edge, you'd say, when talking about the financial analysis side? Or
be my observation, looking at the buy side as a whole, that not enough people know enough about accounting, and it's kind of not been important when the stock markets have been going up so much. But I can guarantee you that if you look over time, it will become more important, and I think people have underestimated the help you get from really understanding how to look through a 10K or a company's annual report. It's remarkable how much you can tell without even knowing anything. If you give me an annual report, you give me a balance sheet and a few ratios, I can tell you quite a lot about that company without you telling me its name.
Talk me through being partner at Tosca Fund, you're head of research at Altima Partners as well. What was the philosophy? I understand that you operated with a special situations approach. How did you think about investing?
I've had various buy-side roles at different places, and what I can tell you is that I did deep dive special situations research, trying to make high returns through concentrated bets in very high conviction ideas. So I did very, very detailed work and would go right through not just the financial aspects of the company. Obviously my background dictates that that was one of the core elements of my research process. But we would look in very great detail at the company's historical revenue growth and the prospects for future growth. We look in very close detail at what that company's achieved in form of margins and what its global competitors did. If you do more detailed work than most people in the stock market, you can produce an edge. Although I generally worked for hedge funds, we were very long term and very fundamental in our approach. We weren't looking to do, trade over a quarter's results because funds were too big. We couldn't have got in and out over a quarter. We would move the price just getting in or getting out. So we had to take a longer term perspective and had to look further out and had to be more knowledgeable because we didn't have the opportunity to trade except maybe at the short side where we would have smaller positions generally.
And on that point, given that you were longer term focused relative to maybe some of the multi-managers that have a more opportunistic or shorter term approach, and then as I mentioned earlier, you've got the long only side, which tend to be the opposite side of the spectrum. How do you see things progressing over the medium to long term? Over the past couple of years, you've seen AUM migrate more to the multi-managers and maybe leak away from the long onlys. Where do you see the ultimate winners in terms of strategy over the medium to long term?
Well, I don't think I don't think a dollar's migrated from the long onlys to the multi-managers. I mean, what's happened is long only funds have lost to passive, and multi-managers have taken market share of alternative of the hedge fund world. To be successful multi-manager strategy, as the name suggests, you have to have a lot of capital and a lot of managers, right? Mm-hmm. And you need to have the ability to move the money around. And the problem, I think, that some of these desks have is they've become too big. And, it's very hard when you're incentivizing people based on, we'll give you a share. So you got $1 billion fund, $1 billion allocation, and we're charging 2 and 30, and we're going to split, and whatever the split is, depending on the person, we're going to split that 30% between the firm and you. It's very hard for them to resist taking another billion and going from $1 to $2 billion because they'll make far more money even if their returns are weaker. And, the scale is the enemy in that sort of business because the more money you have, the harder it is to trade it. So if you're in a short-term trading game, what you want to do is you want to be nimble. And when you're managing billions of dollars, it's just really hard to do that. You might be able to trade the Nvidia quarter, but there's a relatively small group of stocks that you can be in and out in size over a quarter. And I mean, I must say, I've got friends that do that, and I've often wondered just how they do it, because I don't think it's a very easy thing. I don't think it's a very easy thing to do. I think it's a really, really hard thing to do because I'm a pretty detailed analyst. I would have more knowledge than most people in the market about the stocks I was involved in, and I couldn't have told you whether they were going to go up or down in the next quarter with any degree of precision, except in maybe 10% of cases. So it's hard to find enough opportunity doing that strategy. I mean, sometimes the stock market has got it wrong, and that the earnings are going to be better or worse than the stock market expects. But today, it's become even more nuanced than that, because even though you may have a very strong view on that, and you may be right, whether you make money or not depends on the positioning of your peers into that. So if everybody's thinking that, then you won't make any money.
And that, I expect that's where the longer term approach things will play out on the fundamental side, when alluding to your process or philosophy a moment ago.
The longer the longer your time scale, the more the fundamentals count. It's Ben Graham's, in the short term, the market's a voting machine, in the long term, it's a weighing machine. Longer term, you can bring your analytical skills to bear and be more confident about the outcome. The shorter the time horizon, is it going to go up or down in the next minute? Well, nobody knows that, right? Nobody knows whether it's going to go up or down.
Sure. And when you look at behind the balance sheet, you've been running the business now for coming up to 13 years. What are your core offerings if you were to introduce the company, and which of those services has been particularly successful?
Behind the balance sheet set up as a training business in 2018, and we started doing courses, and particularly the forensic accounting course, which has been our most popular product in May 2018. So we've been doing it for 7.5 years, and I don't know how many hundreds, maybe 1,000. I don't know. I honestly couldn't tell you how many people have been through that program in that period, but it's been a lot. And our forensic accounting, forensic analysis course is it's a one-day course. We normally do it in 2 halves because it's a lot to absorb in a day. Most of our clients are very busy and they can't afford to take a day out of their schedule, so we normally do it in 2 halves. And we go through all the skills, tools, and techniques you need to be a more serious investor, to be able to analyze company accounts. And we go through a whole bunch of tricks that enable you to process financial data more effectively, more efficiently. It saves time, right? If you know what you're looking for, you can kick out bad companies earlier in your process, and that's a real efficiency improvement. And we also do a sophisticated valuation course, and we do some more entry-level courses. I just finished training some people last week, some more junior people who are over from the Middle East. And
is that mainly those that are in institutions now or working in investment teams, or is that more cohorts of students? Or
we'll train anybody, but we're quite expensive, so it's mainly the institutional investors that can afford and can justify the cost, because we're more expensive than most training firms.
And where have you seen the majority of the demand come from? Is it more the individuals that are investment managers, wealth managers, asset managers, or even hedge funds, and those that have got 0 to 5 years worth of experience that are kind of in the earlier stages of their career, or is it more those that want to refresh the toolkit that have got 5+ years? Where have you seen most traction with the courses?
The forensic accounting course we've done, I couldn't count how many, but lots of people. Dozens of people that manage funds of over 1 to 5, and over 10 billion. I've got several clients that are responsible for over $10 billion in a fund, and we don't mind whether you manage 500 million or 5 billion. It doesn't really make any difference to the way you apply the techniques. But what I think is quite interesting is the fact that people that manage a $10 billion fund are prepared to give up their time to improve their skills, right? Which is quite interesting, because you imagine that somebody that manages a $10 billion fund, you imagine they're quite good at it. And the fact is that quite a few do. But our client base ranges from those people, which are kind of our core, down to, I don't really do graduate trainees. My client base is gone from being probably 80% long only and 20% hedge funds to being probably about the other way around in the last couple of years. So we're doing far more hedge funds, far fewer long only.
Well, why do you think that? Why do you think that might be? Why do you think that's the case?
Because many of our long only clients have lost funds, and they're got limited budgets, so they don't have the budget to spend on training. If you lose AUM, it flows directly through to your revenue. You get no offsetting reduction in cost. Training seems to be a useful pot to steal from. It's very short-sighted. I mean, I think the industry has been, really very short-sighted because, of course, they're losing money to passive because their performance hasn't been great. Well, how do you improve your performance? You might want to improve the skill set of your team.
Makes sense.
And so, ironically, because you're faced with revenue pressure, the best way to address that might be to increase your costs and spend some money, invest in your team.
You've got many, renowned investment managers that have used your course and have found it particularly useful. But have there been any notable success stories where individuals may have, been struggling to break into the industry, done one of your courses, managed to get on, or even managed to really uptick their performance from using your training tools?
Investopedia described it as the most comprehensive investing course available online, and we've got multiple success stories there. I mean, I've got one client who sold his business. He didn't want to give his money to idiot wealth managers, as he put it, because he interviewed a whole bunch of them, and they wanted to charge him 0.5% to 1% to put the money in Terry Smith's fund. And he thought, well, actually, I can do that myself. I don't need you to help me. And he didn't feel that they were sufficiently talented to invest in direct equities. And he decided that he would do it himself. And so he would learn. And he has made a fortune. I mean, he made a 7-figure sum in the first, 3 or 6 months. Because the training was very good, but more importantly, it gave him the confidence. He's a really smart guy, right? But you wouldn't have the confidence from reading a book and learning. But because he'd done my course and he spent time, we do interactive webinars and so on. He really learned, and he's taken me out more than once. I've got another client. I just noticed actually that he joined one of the very high profile guy who's setting up a hedge fund. He's now a partner of that fund. That fund is up 35% or so this year.
No way.
I don't know how much money they run. 1 billion, 2 billion. I don't know how much. But when he started, he was a junior analyst at a wealth manager, and he learned the skills, and he was very diligent. And he's now, making, I don't know how much, but I mean,
sure.
He must be making, he's probably making millions.
Really
right?
Changed the trajectory of his career by doing the course and going from, a wealth manager to being a partner at a hedge fund. Sounds like
obviously there's a degree of luck involved in,
Yeah.
I'm not saying do my course and you become a partner at a big hedge fund, right? I mean, I wish I could guarantee that. But, the fact that those stories and stories like those exist suggests that you feel more confident because you feel that you know what you're doing, and that transmits itself when you're interviewing. You really and you can point to examples that you've learned, and I know that people at some of my clients have left and gone on to better jobs. I can't say that it's because they did my course. I mean,
sure.
Obviously. But my clients self-select. They're some of the smartest people in the industry. Why are they doing my course? Because they worked out that they can improve their performance, and it doesn't take very much. You only need to miss one dud company from some tip you've got from spending a day in the classroom, and that one bullet that you've dodged will enhance your portfolio performance, and that's all you need, right? I mean, you only need one, and you're already on a different trajectory.
That's really interesting, and my understanding from looking into the different courses you offer is that it's minimizing the number of, as you said, those stocks where you may miss something and it may turn into a very poor performer. So that attention to detail, whether it's being in the accountancy side or the different elements of the analysis process. On the side of AI, I know that everyone's talking about AI, and how have you incorporated, if any, have you incorporated that into any of your courses, or do you see it being helpful within investment teams right now and in the near future?
Well, I mean, I don't teach AI, I'm just look at me. I'm not a young um, genius programmer.
Hmm.
Um, we do one course, which is like an intermediate level course,
Hmm.
which is looking at counting red flags. So it's kind of like the basics of how you spot trouble.
Mm.
And we've done that with, here's how you would design the AI prompts to build that into your Excel or whatever process. But we don't produce the prompts.
Hmm.
So we're pre-prompt stage because it's not my core skill,
Mm.
and I'm offering people tuition in something that I'm very, very good at, and I'm not very, very good. I'm rubbish at AI. I've written several times in my Substack and posted on LinkedIn about the problems I have personally in using AI to make myself more efficient.
How do you foresee it impacting the composition of an investment team? Do you see it, reducing the number of junior analysts that may be needed to use, or and therefore more focusing on individuals that have a higher level of experience, or what's your take on how it may impact the?
I can't think of anybody that's got rid of. Oh, actually, I tell a lie. I got one client that's got rid of a couple of analysts, and what they did was they got rid of a couple of analysts and told the rest that they had to become proficient at AI and make up the productivity.
That's really
And
interesting.
that was uh, that was quite an interesting um, thing. But it's a client that's got far, I mean, a huge excess, a huge surplus of research capacity. So, they are looking forward and saying, well, we need to be better at AI. We start with zero. Let's figure out how we can accelerate that. And, that's kind of how they've approached it.
Sure.
But, the simple fact of the matter is that if you don't take on any graduate trainees, say, um, you know, 2 years down the road, you won't have any 2-year experienced analysts. So
Mm.
if everybody does that, well, what's going to happen?
Mm.
There won't be any junior analysts. There won't be any senior analysts. I
Mhm.
mean, you can't run an organization like that, particularly a large organization. I mean, I've got clients that don't take on graduates because there's a frictional cost to train the graduates, and it can sometimes be difficult to keep them.
Mm.
I mean, the whole thing with AI, I always ask people, what are you doing with AI? And
Mm.
I've yet to find, apart from the data scientists, because obviously they're competent at using it already.
Mhm.
Um, Apart from that small group, generally speaking, what people are using it for are quite superficial
Mm.
things. And it's usually, it's oh shit, I've got this meeting this afternoon with this company and I haven't done any work. What are the issues? What does it do? I don't know what it does. And you can ask AI and you get a very quick response, a very easy, simple response that takes you to a level that you can have a meeting that's not embarrassing. And you can do that very quickly without having to dig through a whole pile of things. So it's quite efficient for that sort of thing. But, where we are today is quite superficial.
Mm. I think you've had quite a unique path when it comes to sell to buy side is it's a traditional step to make, but going from the buy side to more of an entrepreneurial journey of teaching individuals. Where did that motivation come from?
Well, I mean, again, it's just serendipity. It wasn't. There was no grand plan. But I, one of my friends said, "Oh, I was looking at what to do next," and one of my friends said, "Oh, I've got this really bright guy that needs some training. The PM doesn't have time to help him, and we need somebody. Could you do it?" And I thought, well, that sounds quite interesting. And I was just working out what to do next.
Mm.
As I started doing that, and then word got out I had a training business, and my friend Russell Napier called up and said Stewart investors would like someone to build them a forensic accounting course, and I said they should speak to you. And I said, well, what are you talking about? I said, I couldn't do that. And he said, well, why don't you have a word with them? And I had a long conversation with them, and I said, well, listen, I don't know that I can do this. I've never done it before. I didn't want to promise them something and then come back to them and say, well, actually. And they said, oh, well, look, we can't find anybody else that sounds halfway competent. You at least sound halfway competent. So what we need this, and why don't you have a go? And so that's how I ended up doing it. And, it's been, it was really fun. I mean, I set a budget with them as to how much time I would spend, and then of course I got really interested in it. I spent far longer than
you anticipated, yeah, because it's a passion.
But it was interesting, right? So what I do now, writing the newsletter every week. I didn't plan on writing a newsletter, but Substack approached me and said, "Why don't you write a weekly newsletter?" And I said, "Well, to be honest with you, I'd rather go to the dentist every week." And I don't like going to the dentist, as my dentist will tell you. And she always laughs when I come in. But I started doing it. They offered me a lot of money to do it. So I thought, well, actually, why don't I have a go? And then I thought, oh, crikey, what am I going to write about? And I didn't launch until I had a spreadsheet with 70 topics. Because I thought, I was committed to writing a free and a paid letter every week. And I now really enjoy doing it. I've got more stuff to write about than, I've not that spreadsheet. I mean,
what can you expect to see on that newsletter? What is that? More updates in the market? Is it more specific cases where you've seen certain things happen that relate to forensic accounting or frauds or anything like that?
I do a mixture of things. I just write about what I think is interesting. So, last week I wrote about a conference I visited. I mean, I do quite a lot of write-ups, because I've found that people don't have time to go to all these conferences, right? And, I can go, and I'm reasonably experienced, obviously, and I can work out, here's what's interesting. And so rather than spend a day or send an analyst spend a day or half a day or whatever going to a conference, you can spend 15 minutes reading my newsletter, which tell you everything that you need to know, everything that I learned at that conference. Berkshire Hathaway had some big changes last week, and I was very surprised because everything, if Warren Buffett sneezes, it's on CNBC, and there's been very little analysis of the changes. And by Berkshire standards, the changes last week in the personnel were, dramatic. And I think that there is some interesting implications. So, I'm not a Berkshire Hathaway commentator by any stretch of the imagination.
No, but that's current. It's interesting and therefore, worth writing on.
Well,
especially as it's not.
I own the shares, so I'm naturally interested.
Sure.
And I was naturally interested to understand what Todd Coombs' departure in particular meant for my investment, and I haven't seen anybody write a sensible analysis of that. So I thought, well, I'll write. I mean, it might not be sensible.
Sure.
No. I wrote what I took away from that, and some of it's very topical, like that. I heard this guy pitch this stock, and he's an idiot. I did that. I didn't name the guy, but I went to a conference in New York, and the professional managers stood up and pitched this stock, and he projected the free cash flow for the company for the year, and I had a look at the stock. I thought it was quite interesting. I thought he was talking rubbish, and when I looked at the free cash flow of the year, he had it with a free cash flow yield of 5%, and I had it with a free cash flow yield of -3%. And I could bet him $100,000 that that I would be closer to the right answer. I only spent 10 minutes looking at it, but I don't know why he had this fantasy that the company was going to be so cash generative, because it clearly wasn't. And so I'll talk about that sort of thing because I
Okay.
think that those when somebody gets something very wrong, you think, well, maybe I'm missing something.
If you could allocate to a particular stock market going into 2026, where do you think there is most opportunity?
Yeah. Well, I mean, I have to say that, clearly the US market isn't cheap. I think the problem with the US market is quite risky, right? And, the hyperscalers in particular, it seems to me there's no question that their returns are going to fall. And usually when companies' returns fall, the rating follows. And that hasn't happened as of yet. And there's quite a good reason for that because there's a lot of momentum behind these stocks, and there's still a lot of enthusiasm for the US stock market, and there's a lot of index buying, which is supporting these stocks' valuation. And I've got no idea when that will stop. I can't predict what the retail investor is going to do,
Mm.
right? I mean, the retail investor could carry on buying, and some people said, "Oh, we're in a bubble." I mean, I haven't said that we're in a bubble. I mean, I think there are some overhyped areas, not necessarily of the quoted markets, but particularly in the private markets. I think some of the valuations are amazing. Now, maybe, I mean, we don't know. When we're at the cusp of a new technology that we're only 3 years into, and it could be that OpenAI is worth $500 billion. I mean, that could be the outcome in
Mm.
5 years' time. I think it's highly unlikely,
Mm.
and given the risk, I would have expected the valuation to give you quite a lot of upside.
Mm.
But I mean, we don't know, and your guess is probably as good as mine,
Mm.
right? I mean, I don't know how OpenAI is going to
Yeah, I
monetize
totally
its
understand that. So
business.
it sounds to me that you're probably, from that perspective, the US isn't a difficult. Well, it's a complex market given the fact that you don't know where AI is going to go. If you look away from the US, are there any other stock markets you feel that there are potential upside?
But what I was going to go on to say was that I think, and I'm on record as saying that I think the U.S. Has peaked as a percentage of the global market, and I don't think we'll see it recover or if it recovers those highs, they'll only be temporary. I mean, I think the U.S. owns too much of the global market capitalization, and I think other markets will do better than the US, as indeed has been the case this year. In spite of the recovery the US has made, a phenomenal recovery from the post-Liberation Day lows,
Mm.
which, honestly, that wasn't my central case, because my central case was that this was a very uncertain world, and I thought that China was going to get the better of the US, which indeed it has. But I didn't think that the US stock market would be quite as sanguine about that as it has been. And I must say I'm surprised that the US profit margins have held up as well as they have, because the tariffs haven't been fully passed on,
Mm.
but you haven't seen much of an impact in margins yet. And that might be partly by the early stocking, but all the prognosis is that earnings is going to pick up in 2026. So clearly, what I would have assumed would be tariffs would generate inflation and profit margin pressure, and that prediction was wrong. But I would continue to believe that you'd be better off in other markets, and I think the UK is obviously cheap. I think Japan is still quite cheap. I've been quite impressed by the Korean stock market's performance. I know the last time I looked, it was up 60%.
Mhm.
It's up 60%, and if they can introduce the reforms, which I'm dubious about, but if they can introduce the reforms, then the Korean stock market is probably still cheap.
Mm.
I've got no, I don't have enough insight into whether the K balls or Kai balls or however you pronounce them, whether yeah, whether they will give in or
Mm.
whether they'll resist as they have for decades. But yeah, I mean, I think there's plenty of opportunity, and I've just bought a stock today, But I looked at it, I couldn't believe how cheap it was. I
Mm.
was just talking to somebody, and he said, "Have you looked at this stock?" And it's a company that I am a customer of, and the
Mm.
stock market thinks it's an AI loser. And I'm looking at it thinking, I don't care what AI does, but I use that service and I pay them hundreds of pounds a year, and I can't imagine in 5 years' time not paying them hundreds of
Mm.
pounds a year. I don't know. I think I pay them almost £1,000 a year. So you think, well, that's really cheap, and the stock market's got that completely wrong. So I think there's huge opportunities. That happens to be an American stock, ironically.
Which
So
stock is it?
it's a US tech company that's been singled out as a AI loser, and it's probably at the margin an AI loser, but I think it's got a much more resilient customer base than the stock market's realised.
And which stock was that?
I didn't say.
Okay. Keeping it under your
Good
hat.
try. Good try.
Yeah, that's a good try.
I've just started buying it. I'm not about to, you
No,
know,
that's fair
tell
enough.
the world.
No, that's fair enough. But no, Stephen, it's been great speaking with you. Years of experience, and really interesting to understand, the transition from going from sell side to buy side to the entrepreneurial journey. I have a lot of respect for that, and yeah, I could probably learn from you all day and on your courses for many years as well. So thanks for coming on. It's been a pleasure, and hopefully you have a lovely Christmas and a good New Year.
Well, thanks for the kind invite, and I appreciate you taking the time and trouble. And if people want to find me, I'm on LinkedIn, and I post regularly there. And the website is behindthebalancesheet.com, so very easy to find me.